Well, let's get started, shall we? Good morning, everybody. Welcome to Gulf Intelligence Daily Energy Markets live video podcast, Friday, the 3rd of February. I'm Frank Kane. This morning, Brent oil is at around $81, kind of at the lower end of the 80 to 90 band that it's been stuck in for a while. There was no change at the OPEC plus JCPPA meeting earlier this week, which was no surprise. But it makes you wonder what it will take to get that oil price moving again. Here this morning with me are three experts who I'm sure will be able to enlighten us on that. Let me first welcome Dr. Imam Nasseri, Managing Director for the Middle East of the FGE Energy Consultancy. He's in Dubai, where I am too. He's a downstream specialist with some considerable background in Iran. So let me ask you, Dr. Iman, what will it take to get this oil price moving again? The JCPPA left things unchanged. They still seem to be worried about China, don't they? But what will it take to get it moving again? And do they want to get it moving again? Are they happy with prices at these levels?
Yeah, I think the OPEC Plus group have over time raised their, let's say, preferred or target price in mind, although they have been repeatedly saying that we don't basically regulate for price, or we don't follow the price. We look at the balance, but the market has been, and we've been thinking that their basically right price for the oil has increased over time to currently we think that about $80 to $100 range. That's the right price. So we're still, I think, in their perspective, the price is right, hence the no action. But also when you look at the market balance, also it suggests that the market is just about where the current OPEC plus output is in terms of call on OPEC plus, and hence basically no need for action. However, there are two big uncertainties that still are ahead of us, and one is China coming back, and I think the market is anxious and waiting to see that big recovery in demand and basically the impact of reopening in China, but also how much Russian supply of crude and products or refining capacity gets out of the market. At the moment, we think, looking at the fundamentals, that price may if anything, there is more downside risk in the first quarter before we think the China demand come back in second quarter and get the price going back
Right.
upward track.
Okay. Let me go to Matthew Wright, Senior Freight Analyst at Kepler, based in London. Hello, Matthew. Your first time on the show. Welcome. Regarding China, what's your view about the recovery, then the timing of the Chinese post-COVID recovery? But also, what will be the sign that we see that will tell us that China is back? That maybe OPEC Plus will be able to see, right, okay, that's it. We will start pumping more.
Yeah, good morning. Thanks for having me. So obviously China's been a massive focus. It always is. And I think over the last couple of months, it's drawn even more attention because of the volatility in crude imports and products exports. So I think a couple of things to look out for. So obviously on the freight side, I'm always looking at what's coming in and out. And on the product side, we had this huge record level refined products exports in December from China. And that dropped away quite sharply at the beginning of the year. It's picking back up again now. They also allocated 15 million tons of refined products exports in the first batch this year, so of quotas. And I think that's kind of an interesting wrinkle, because while domestic demand is coming back, it's also a sign that they're still looking towards the export market after a year and a half of being, turning their back on the export market. That suggests that they're really giving refiners the chance to make some money again after missing out on some of the huge cracks that we had sort of earlier last year. I think that it's the usual combination of crude imports, onshore inventories, and refined products exports. That's going to be the best signal for what's going on in the domestic demand market there.
Right. Matt, let me stay with you to put to you the other big thing looming, of course, next week. I believe it's the 5th, is the European ban on Russian products. Tell us what effect that's going to have on global markets and on Europe. What's your view there?
Yeah, absolutely. Yeah, we've got 2 days until the import ban and then the associated sanctions that come along. So we're going to have new price cap or price caps for refined products. So obviously for crude on December 5th, we had the $60 a barrel. For refined products, we still don't know what that price is going to be. It's sort of in the 90 to 110 sort of range. And we're expected to have probably 2 price caps, one for high quality products and one for low quality. It's very, very bit of a blunt instrument, but that's sort of the approach they're going for. In terms of the import ban, so unlike on the crude side, where EU countries had significantly reduced their intake of Russian crude ahead of December 5th, over the preceding months, through combination of, actual bans from the UK, but also self-sanctioning among other EU members, we saw imports really draw down and other countries such as India and China ramp up. Whereas on refined products, we've seen much less of that. Even last week, the EU was still taking in 700,000 barrels a day of Russian gas oil. So there is still a huge amount that both the EU needs to replace and Russia needs to divert. So we do have a bit more of a shock to the system in terms of changes in a much shorter period of time than we did for crude. And with that comes logistical difficulties. Russia has to secure relationships to find a home for all of that. In terms of Russia, I think they'll have relatively little problem finding buyers for gas oil. It's very in demand. There's a lot of countries that will very happily take discounted Russian diesel.
Which are the more likely customers for them, Matt?
So Latin America. So there's been long discussions with Brazil around that, and I think that should go ahead. I think West Africa is a good potential. Otherwise, within the Mediterranean, so we've got Turkey is ramped up and is taking a lot more. So I think those, and then there's buyers in North Africa as well. I mean, there's also the potential for some countries to take it in, bring it in onshore, and then it gets sort of mixed up with domestic production and re-exported back to the EU. We just don't know. Once those molecules are all commingled, you don't know what's Russian.
Yeah. It gets mixed up. You mean deliberately or by accident?
Oh, yeah, potentially deliberately. We don't know. Yeah.
Okay.
The bigger problems are naphtha, however, naphtha and then the bottom of the barrel. I think there's fewer buyers for naphtha in the West, and I think that the main destination would be Eastern Asia, and a lot of those countries have long-standing relationships with Middle Eastern producers that they're not necessarily about to turn their back on. So Russia might have a bit of a problem sort of placing some of that naphtha. I think there's still about 200,000 barrels a day coming to EU countries that would need to be moved. And then there's and then VGO and bottom of the barrel products as well, where the reduction in imports from the US has seen some changes in trade flows. A lot more is now going to the Middle East, into Singapore, into Asia, but there's a big slug left to move. And then then there's Europe. We've got to, here in Europe, we've got to bring in winter spec diesel, and Russia has been producing that for Europe for years. And winter spec diesel is not something that everybody can make. We've got huge refineries in the Middle East, but they don't all produce winter spec diesel. And sort of the delayed startup of Jazan, Al Zor are sort of potentially contributing to that tightness.
The kind of accepted wisdom is that Europe is safe for this winter, isn't it?
Yes, yeah. I think we are now. Where are we now? Beginning of February, we're coming out, and I think there's ARA stocks rose 1 million barrels a day week on week, I think, this week. So that, you know, things are looking considerably better on that front. But we've got a big job of replacing that supply.
Okay. Let's go across the Atlantic and welcome Dr. Umad Shokri, Washington, D.C. Based energy strategist, senior foreign policy advisor, author of a book entitled U.S. Energy Diplomacy in the Caspian Sea Basin, Changing Trends Since 2001. That's a very hot part of the world at the moment, Dr. Umad, isn't it? So thank you for joining us in the early hours. We will come to the Caspian a bit later. But first of all, just give me a sort of overview of where we are now in global energy policy and a US view, if you would, of what effect the European ban will have next week.
Yeah, thanks for having me, and good night from the Washington.
Pleasure.
Question and today's global market. First week of January, I wrote a piece about the global energy market by 2023, and I mentioned about the three major factors will affect the global energy market, mainly oil market by this year. One of them is supply and demand in the market. Another one, the future of the current war, I mean Russia invasion of Ukraine, and also the last one is China reopening. I mean China's the continuing China's zero COVID policy. And during the last week, we can see some progress in China economic, and economic growth means more demand on energy, and China is the major energy consumer. And any progress in any economic growth, any progress, any reopening in the China means more demand and means more increase in oil price. Referring your question, yes, by the last 2 years, the Biden administration many times reached to the Saudi Arabia and other Arab countries to boost oil production capacity, to pump more oil to the market, to oil price goes down. But we can see that there is a good cooperation between Saudi Arabia, other Arab countries with Russia to follow their own national interest in the market. Just they focus on the demand side. I mean, they just own national security of OPEC Plus member, not consumer side, such as the US, EU, and China or India as well. And we can see the OPEC Plus continue the same policy this year, and we have seen new round of the meeting by 2 days. These days. And U.S. needs more cooperation with the Saudi Arabia. U.S. needs more to open new chapter in the U.S. Washington Riyadh relation. If U.S. wants to really create a balance in the market, needs more cooperation between Arab countries, mainly Saudi Arabia. Without the cooperation between Saudi Arabia and the other countries, we can see this year and next year and in the coming years, the country just focus on their own national interest, and they just maybe want to pump more oil to decrease or increase oil production capacity, just related to their national security and economic security and their own interest, not the interest of U.S. and other energy consumer. We can see more progress by coming months, and as I mentioned, the real factor will be affected the current war between Russia and the Ukraine. And if we can see peace or the end of this war, we can see new the world and energy dynamic will be changed by coming months. But it just depends on Putin himself. Once he wants to cut war or continue war. We can see.
Tell me, Dr. Umad, one thing, just to pick you up there. Oil prices haven't risen as much as we might have expected after the October cut, the 2 million barrels in theory cut. What has been the reaction in the States to that? You know, President Biden must be quite happy that gas prices are going down, isn't he?
Yeah, you know, last November we see the midterm election, and before the midterm election, Biden administration reached Saudi Arabia and very angry about the OPEC Plus decision regarding a cut 2 million barrels of production capacity. But as you mentioned, during the last week, we can see the oil price goes down, and it's in favor of the U.S. economy. And we have seen that by next year, 2024, a new presidential election in the U.S. and energy prices and energy market market, stability in the energy market in the domestic and internationally is directly affected the next round of a presidential election, and Biden trying to use any means to create a balance in the market to gas price and oil price goes down, mainly in the U.S. domestic market. And I think if I want to sum up in just one sentence, energy security in the U.S. means the gasoline price, the gas price in the pump station, and it's directly the U.S. high inflation rate and also U.S. public decision regarding the next round of election. And Biden is aware of the importance of the creating balance in the market and the gas price and the continued current energy crisis in the domestic and internationally. And as I mentioned, Biden administration, Biden himself, National Security Advisor for White House, Energy Secretary, and also Senate comes together and trying to play an active energy diplomacy to create a balance and keeping the current situation in the market by coming months, mainly by next November and the type of presidential election in the U.S.
Okay. Let me stay with you, Dr. Umar, because one thing that gets oil prices moving is a good old bit of conflict. We've had plenty of that in 2022, of course, in Ukraine, but it hasn't really had the results, apart from at the very beginning when oil prices spiked. It hasn't really had that kind of result since. Now, you are an expert on one of the most conflict-ridden parts of the world, Iran, the Caspian region. So I'm wondering what your outlook is for the Caspian, Central Asia, and in particular the kind of rumbling confrontation between Azerbaijan, Armenia, Russia, and potentially, I guess, pulling in Iran, Turkey, maybe even Israel, into that nexus. What's your view there?
Yeah, thanks. It's a very great question. And referring to your question, Russia is the major player in the Central Asia, Caucasia, and Caspian Sea at the same time. But Russia just since the last February, just the main concentration just focused on the current Ukraine war, and due to the first priority for the Kremlin to this picture of the war. But next week we have the new round of energy diplomacy played by the Azerbaijan Republic, and we have new energy summit in the Azerbaijan. And by 14 and 15 of February, we have the new round of energy summit in the Turkey. As you know, Turkey is trying to be energy center and energy trade in the region. It is a process. Turkey has the potential to be energy center in the region, but as we know that EU is against to importing more oil and gas from the Russia, and Turkey will not be able to re-export natural gas from oil LNG from the Russia to European countries. But Turkey started its own plan to be energy hub in the region. As I mentioned, it's a process, and it is more 1 or 2 decades to Turkey to become energy center. And referring to the Caspian Sea Central Asia, EU is interested to import natural gas from the Turkmenistan. We know 2 decades ago, the Trans-Caspian pipeline deal signed by the EU, Turkey, and Turkmenistan, but we have seen no major progress in the region. But Azerbaijan and Turkmenistan working on there, and they are trying to connect 2 natural gas field in this Caspian Sea, and to bring natural gas from the field from Turkmenistan to Azerbaijan and pump it to gas corridor and to export it to Turkey and to EU as well. And we have seen in the future what's going on. And Iran has own problem, as you know. During the initial weeks of January, Iran faced a huge energy crisis and natural gas shortage. With regard, Iran holds the second natural gas reserve due to high domestic consumption and continuing sanction and mismanagement. Iran faced the energy crisis and will not be able to play an important role in regional and world energy security perspective. Iran needs reviving nuclear deal JCPOA and lifting the sanction, and Iran will be able to be a player in the natural gas board. I mean, in regional world by next decade. Iran needs at least.
Sorry to interrupt, Dr. Umut. Can we slow down a little bit? We're just trying to catch up.
Sure. Okay. Sorry. And as I mentioned, Iran needs to reviving this new deal, and in any, as everybody knows, new geopolitics and new geopolitical event directly affected the world energy market, and any confrontation between Iran and Israel, and any confrontation in the region, mainly Caspian Sea and mainly Azerbaijan and Armenia, a new confrontation directly affected the firstly natural gas market, and the second the oil market, as you know at present.
Sorry, let me interrupt you, and I want to get a view from Dr. Iman here, because you know a thing or two about Iran as well, don't you?
Yeah.
So the JCPOA is dead. Yes, is that right? Domestic protests within the country seem to have died down somewhat, but you get the feeling that they are still there, that they could happen any time. Give us your view, Dr. Iman, please.
Yes, the JCPOA is dead for now. And I don't think in any near future we or anyone following the developments, political developments between Iran and the basically P4+1 expect it to revive, especially given what has happening over the last 4 months. However, Iran's crude and condensate and product exports have increased over the last few months, despite the competition possibly with Russia. They have been able to export over 1 million barrels per day of crude to the market, mainly to China, but also some small pockets here and there. And that has basically given them, even from their perspective, perhaps more reason to stay on their stand when it comes to and if there was any further negotiation, which has been indicated by some of the US officials at some point that it's not officially dead and it will continue, as well as some Iranian officials. So
very hard to imagine the US administration getting involved in talks with Iran, while these very violent protests are going on, isn't it?
It is very unlikely. But for whatever reason, and for political reasons, perhaps they decided to stay on that line that the democracy is open, the line of democracy, and we're still going to continue the negotiation, and Iran says so. But as I started, the JCPOA is that. What I wanted to make one comment regarding the OPEC plus target and the 2 million barrels per day cut that you referred to. If I don't know if I can, well, my screen sharing is disabled. I wanted to show a slide here to show that basically that 2 million barrels per day cut was in fact a much necessary action to support the prices because the spare capacity had risen to nearly 4 million barrels per day, and the impact of that was minimal. But looking forward, and given our forecast for China coming back to the market in second quarter and adding up to 1 million barrels per day between second quarter and the end of the year, still basically looking at what the real output from the OPEC plus countries are, we don't see much of an action needed at the moment. Again, depending on how much of Russian supply one thinks will leave the market, which at the moment, again, we think and looks like over the last at least 2 weeks, and that's perhaps why the bearish sentiment and downward pressure on prices is that the concerns over supply out of Russia has eased a bit.
Right. Matt, let me come back to you on that. How much Russian crude and product, I guess, will be lost this year, do you think?
So on the crude side, it looks like very little. So initially there was a bit of a downturn in the initial period after December 5th. But I think there was some sort of various reasons for that. There was weather-related delays at Espoo, so we saw a lot of loss there, and there was actually a big ramp up in refinery runs in December, which saw more crude diverted from the export market. But now exports are sort of back up and are trending fairly steadily. I think our outlook for refinery runs is pretty steady this year. We're not expecting any significant drop off. And so it really kind of comes down to refined products exports. And as I said, it's unclear. I think gas oil is going to be fine. And then it's the other products and whether they can find new buyers. I think, touching back on the freight side, which is sort of my area of specialty, there were a lot of concerns that, unlike on the crude side, where Russia has sort of built a very large sort of grey/shadow fleet of vessels to move product and avoid having to trade under the price cap. On the product side, there were concerns that maybe they hadn't done this and maybe they weren't enough. But actually, I'm beginning to see we're seeing a lot of secondhand sales of vessels on the coated tanker side, and so I'm less concerned now that that's going to be a problem. But what we are expecting to see is a big increase in freight rates, because at the moment, so the beginning of the year, both crude and dirty tanker and clean tanker freight rates have been particularly weak after a very, very strong 2022. But following the EU import ban, we're going to see obviously huge diversions in where products are going. EU's having to bring product in a lot further and Russia's having to ship it a lot further. And for MRs and LRs, that's going to be a huge increase in demand. So we're going to see ton miles really blow out. So sort of the current weakness we're seeing in the freight market should be short-lived, but it has, to be honest, the weakness in the market has surprised us to an extent because it has come off such a strong December.
Right, I get it. I want to talk a bit about the energy transition. And can we pull up the poll survey question, please? I mean, this is a little bit mischievous, maybe, but prompted by the huge profits that we've seen from the independent oil companies over the past few days. Shell yesterday, record 40 billion. So my question is, where will this money end up? So the poll survey question this morning is: the huge profits announced over the past week by independent oil companies will result in, and choose one of the following, please. Big investments into hydrocarbon resources, number one. Number two, massive expansion is wind, solar, hydrogen, and other renewables and alternatives. Or three, bigger bonuses and share buybacks. So if you can choose one of those, please. Give me your thoughts briefly, because we're running near the end. Dr. Umad, what does this explosion in oil company profits mean for the energy transition?
Yeah, it's a great question. As you mentioned, the Chevron profit, it's about the $36 billion, and ExxonMobil 56, and the Shell 40, around the $50 billion. And the energy crisis was in the favor of huge energy companies in the West, and mainly from the US and the EU as well. Referring your question, energy transition process need hydrocarbon. Without the hydrocarbon, no country will be able to succeed the net zero program. But I think during the next decade, all energy consumer and energy producers focus on energy transition process. At the same time, I think they have to more invest in the hydrocarbon. But what hydrocarbon? I think low carbon. I mean, production of low carbon of LNG, gas, and oil as well. By 2 weeks ago, UAE announced its official program to produce more oil, but 25% less carbon. Yes, Saudi Arabia has own plan, and Aramco is preparing to attract more financial capability and technology to producing low carbon oil. And I think. Yeah.
Let me go to Dr. Iman, and if you would quite succinctly, because we are nearing the end, Dr. Iman, where will this money go? Will there be an explosion in renewables investment?
Yes, according to
Sorry, Dr. Iman Nasseri, please.
Yeah, I look at the menu of the poll, and I feel like it's perhaps a little bit of each of those. I think we will see increase in investment in hydrocarbon more than what market anticipated in the past few years, and we certainly continue to see from the Gulf producers, perhaps with higher incomes, more renewable projects and clean fuel, but also continue to see that those share buybacks perhaps in some of the OPEC plus, non-OPEC producers such as the US companies.
Okay, Matt, won't they just pay themselves big bonuses?
I agree with Dr. Iman. I think it's going to be a bit of everything. I think probably a little bit, and I think that we've got to have more investment in the renewables. But as Dr. Ahmed said, we can't. The transitions isn't going to work if we don't have some more investment in hydrocarbons. If we just stop it, we're going to have a big gap, and there will be some serious problems. So a little bit of everything. I think investment in wind and solar is definitely a massive priority among all the majors, so I think that will definitely continue.
Okay, right. Well, the room is split between renewables and bonuses, 44% each, and not many people think there'll be much investment in good old oil and gas. But we've reached the end. I would like to say thank you to Dr. Iman Nasseri, Dr. Umar Shokri in Washington, and Matt Wright in London. Thank you very much indeed. An interesting conversation, and hope to see you again on the show. Thank you very much. Goodbye.
Thanks a lot.
Thank you.